morning to everyone. My name is Greg Klein from Hayes Financial Group. You'll see my contact information on the slide. Welcome to the presentation. If you've been to one of my presentations in the past, welcome back. Happy to have you. As you see on this title slide, what we're going to talk about today is a little bit about retirement preparedness, which is a bit of a nebulous term. I mean, the information that we'll go through is important information for everyone, but it might be information that if you're getting closer to retirement, you're thinking about more and more. And so we'll see the agenda here in just a second. Just a reminder that we are recording this session, so the chat box works great if you want to submit any questions via chat. I will stop the recording at the end if you want to unmute yourself and ask any questions. We'll have plenty of time for that, but you got my direct contact information there. You can always email me, and then you'll have all of our contact information, so you can schedule time to speak with us at Hayes Financial Group at any time. You'll get that information at the end. So let's take a look at the agenda. We'll have 4 different sections that we'll walk through. We'll talk about important retirement ages, how that ties into Social Security, withdrawals and withdrawal rates, taxes, a bit about important documents. So like I said, information that's really good for everyone, no matter where you are on your financial journey, but information that people that are getting closer to retirement are probably worrying about increasingly. So our first segment is how soon can retirement start? And probably wish that it could start tomorrow, but there are some important ages that we'll look at, those milestone ages for retirement. This is kind of the range of retirement ages. So as early as 55, you're going up to 72. So if we start over on the left-hand side, and we can even, I don't have it on the slide, but we can even go to 50. I mean, if you think about 50 is important because that's the age at which you qualify to make catch-up contributions and things like 401k, 403b, IRAs. But when you're looking at starting to withdraw and retire, we're talking about 55, kind of on the left end of that spectrum. And 55 is important for workplace retirement plans. The second age that you see there, 59 and a half, is the one that you're probably more familiar with. That's an important one to focus on because that's the age at which there is no extra tax, no penalty tax for taking money out of things like workplace plans like 401k, 403b, or IRAs, individual retirement accounts. But if I step back again to that age 55, that's one that applies to workplace retirement plans. So that's a little bit of the gray area with the taxes, where if you separate from service, so if you retire, leave your job in the year you turn 55 or later, from workplace plans like 401k, 403b, you can take money out before 59 and a half and not get hit with that early withdrawal penalty. So just a heads up there, when you're looking at beginning to take distributions, if you're younger than 59 and a half, it could benefit you in your tax situation to take that money out of your workplace plan rather than out of an IRA, because IRAs, individual retirement accounts, will always be 59 and a half. But 59 and a half, you'd want to be safe. That's the age at which there's no early withdrawal penalty. Then we get into Social Security that we'll look at in more detail, but it starts as early as 62. Probably more important even than your Social Security age is that Medicare age at 65 because of the high cost of healthcare today. Then for full retirement, full retirement benefit from Social Security, we get into 66 plus up to 67. We'll see more on those ages in just a moment. To 70, you can delay Social Security all the way up to 70 and get your enhanced payment. At age 72, that's the age at which you're required to start taking minimum distributions from retirement accounts like 401k, 403b, IRAs, and we'll look at that in more detail. But there's our milestone ages. How soon can you start your retirement? Well, for most people, it's going to fall somewhere on this spectrum. It might be your late 50s, up to early 70s, and a lot of those ages and why they're important when you're looking at retirement. So we'll talk a little bit about Social Security. And we saw how full retirement age for most people is between 66, 67. So if you were born after 1960, then you're looking at 67. If you were born before then, it's going to be 66 and some years. And we'll see how that ties in dollar terms to your payment from Social Security. But if you take Social Security, your full retirement age is going to be very individual. So, make sure that you go register your account at My Social Security. Go on to ssa.gov, the Social Security website, register your account. You can see what your projected payment would be at your full retirement age. This just shows average for 2021, average for an individual was around $1,500. And then you can see that's at their full retirement age. So if this person at 67, let's say full retirement age, what it would look like if they took a reduced or early Social Security payment. You can see if they take it as early as 62, it's a 30% reduction or down to around $1,000. It can pay to delay, as I say, if you take that enhanced benefit at age 70, it can go up to closer to $2,000. So those are those ages that we just saw in that range for Social Security. And remember, that's going to affect the payment for the rest of your life. Of course, there's no correct age for claiming. The rule of thumb is if you can wait to get the enhanced benefit, that it can pay, but nobody knows exactly how long they're going to be alive. So it is a little bit of a crapshoot. But Social Security gives you that guaranteed 8% return. So if you wait and get an enhanced benefit, if you wait a year, it's an extra 8% guaranteed from Social Security. And then that ties into things like cost of living increases. You probably saw the press release recently that Social Security had, a really high cost of living adjustment, went almost 6% this year. So if your enhanced payment, if you wait and your Social Security payment's bigger, then your cost of living adjustments are going to be bigger. Survivor benefits are going to be bigger. Things that we'll look at here a little bit more in just a minute. But to wait or not to wait, that's the question that we're all facing. Again, rules of thumb, consider taking your benefits early. If you reach a point where you can't work any longer, maybe it's health reasons, whatever it may be, you can't work, you can't make ends meet, what are you going to do? You got to take Social Security. If you're in poor health, don't expect to live, to an average retirement, let's say 20, 25 years in retirement. Maybe you want to just take your Social Security early. If you're the lower earning spouse of a couple, there's no penalty for taking Social Security early. We'll see an example of that. Consider waiting if you're still working. We'll see in just a minute how that affects payment of your Social Security benefits. If you're in good health, expect to live certainly into your early 80s, because most breakpoints, where you'll see that Social Security benefits you more if you wait to take the benefit is if you live into your early 80s, for sure. You could receive more from Social Security by waiting. And then if you're the higher earning spouse, because if you can wait and you're the higher earning spouse, you're going to get the biggest benefit, and then the survivor would also get the larger Social Security benefit. So some things to consider there with Social Security. We talked about waiting if you're still working. The reason for that is you can get Social Security benefits while you work at the same time, but if you're younger than your full retirement age and you earn above a certain amount, then your monthly benefits, could be reduced, and you see that, or will be reduced, I should say. You see that on the slide, and it isn't lost. Your benefits would increase again at your full retirement age, but they would withhold benefits for you working while receiving Social Security. But basically it works that if your full retirement age, so whatever your full retirement age is or older, you can keep working and get all your benefits. It doesn't matter how much you earn. But if you're younger than your full retirement age, again, why it's important to know what is your full retirement age, then $1 is deducted from your benefits for each $2 you earn above the annual limit that you see there of the $18,960. In the year that you reach your full retirement age, then it's a little bit different. The dollar limit is higher, so they'll reduce the benefits only if you pay above that $50,000 figure, and it's a deduction of $1 for every $3 you earn above that. So there's much more withholding before you reach your full retirement age, the year in which you reach full retirement age, less withholding if you're working and receiving Social Security benefits. And then once you reach your full retirement age, you can work and earn as much as you want and benefits won't be reduced. But that's why I say, if you're working, it just pays to wait. Then you don't have benefits withheld. You can wait and get an enhanced benefit. Survivor benefits is another reason to consider waiting. I think that we get on this slide. So we have just an example, say there's a difference in age, 162, 167. These are just hypothetical. Say the one that's 67, so full retirement age, could get $2,000. The one at 62 would get a reduced payment, $1,200. Well, now when one of those individuals passes, then the surviving spouse has the option of either continuing their benefit or receiving the higher benefit. So you see that the individual in this couple that received their benefit early at 62, it was $1,200. But if the other spouse passes, well, then they could still receive the other spouse's higher benefit of $2,000. So survivor benefits is another wonderful part of Social Security. They're built into Social Security. You have the option to take the higher benefit. And why then we would say that the higher earning spouse, pays even more to delay, because then the surviving spouse is going to get that enhanced benefit for the rest of their life, too. So survivor benefits, working while on Social Security, some of those reasons why you really want to consider that age when you're looking at retirement, and maybe waiting a little bit longer can benefit you. Then we look at our personal savings, withdrawals and withdrawal rates from things like 401k, 403b. And decisions. You got lots of options when you separate from service from your 401k, 403b. You can leave the money, so you can always just leave it in a plan if you have $5,000 or more. So don't think that you're under a time crunch. Some of the advantages of that is, of course, everything is the same. So, you keep your money in the same account, be able to access it through the same website. There might be some cost advantages too, because it's an employer-sponsored plan. And you're going to have best-in-class investments that are relatively low cost. So there might be some advantages to just leaving it. Remember before my fiasco and having to leave with the fire alarm, I was looking at those ages, and I put up there that age 55 that applies to 401k, 403b plan. So keep that in mind. If you retire before 59 and a half, there can be some tax advantages to beginning your withdrawals from a 401k, 403b versus the second option of rolling them over to an IRA. In an IRA, it's always going to be age 59 and a half that applies to be able to take that money out, either tax-free or with no tax penalty. But you can roll it to an IRA. You might have some more flexibility there with an individual account. It's possible it could be a little bit more costly. You want to weigh the cost differential there between your employer-sponsored plan and an IRA. Age 59 and a half is the only one that's going to apply to the IRAs until you get to 72, when those required minimum distributions will kick in. If you're working and you're still working, so you're still participating in your 401k, 403b, and you're working, and you are age 72, you're not required to take those minimum distributions until you stop working. Now, that's not the case for IRAs. IRAs, when you get to age 72, if you have to take that minimum distribution, you have to. It doesn't matter whether you're working or not. So if you plan to work to an advanced age, having that money in your employer-sponsored plan, you don't have to start touching it if you're still working at age 72. And then the last option over there is obviously to start taking money. It's going to depend on what options you have through your plan. But you can take it once, take it over time. Whatever you take in a calendar year is going to be added to your taxes as taxable income. So keep that in mind, especially if you're looking at taking one big lump sum. If you take that in one tax year, that could move you to a higher tax bracket, which we will look at in our tax section. But I mentioned the RMDs are required minimum distribution, so let's focus on that for just a moment. Required minimum distributions, if you're new to this term, this is those minimum distributions that you're legally obligated to withdraw from qualified retirement plans. Starts now when you're 72. The age used to be 70 and a half. If you are thinking of that age, then it got bumped up to 72. They have to start then, by April 1st. the following year, after you turn age 72, and then take it before the end of the calendar year. Like I said, if you're still working, you can delay those required minimum distributions from 401k, 403bs. They're calculated based on your balance at the end of the year. You don't take it, there's a pretty hefty tax penalty. Half of whatever the RMD amount that you're supposed to take was, and that's the tax penalty. You'll get notified from 401k, 403bs on what you have to take. Same way if you have separate IRAs, individual retirement accounts, you'd have to take it from those. If they're traditional type of IRAs, pre-tax IRAs, RMDs are not required from Roth IRAs. So that's a little different there between an employer-sponsored plan that offers the Roth option and a Roth IRA. So just keep that in mind. With your RMDs, you may or may not be able to specify through your employer-sponsored 401k, 403b, where you want to take your RMD from, either pre-tax or Roth dollars. Outside of an employer-sponsored plan in a Roth IRA, there's no RMDs. So a little bit about RMDs, and then we see the table on this slide. This people will also use to determine how much they should really be taking out of their retirement accounts. What it is the IRS table. It gives you a number that you divide your balance by. So my simple example down at the bottom, you have somebody that had $100,000 in their account at the end of the calendar year at age 72. So we take that 100,000 divided by the 25.6, and that says their RMD would be $3,900, just under $4,000 would be their required minimum distribution. And that applies to all those accounts except for your Roth IRA. That's at age 72. Like I said, people will use that, and you'll notice that this person starting at age 72, the amount that they're required to take is around 4%. 4% is sort of that golden rule or gold standard, for making your money last throughout retirement. You'll notice that the RMD is basically around that same amount. So not taking too much so that you run out of money. People use that RMD number also, just to start their distributions earlier on in life. Even if you don't have to take it, you might just base your distributions off of that RMD and say, well, if I have to start taking 4%, that's what I'll take from my retirement account. And we'll see that at 4%, you can take that amount and be pretty confident that your money's going to last throughout your lifetime. That decumulation period, so you work so hard during your career to build up those assets during the accumulation phase, and now you got to switch over to the decumulation, figure out how much you can take out so that you're safe and you don't run out of money. And you'll notice that RMD amount, like I said, was about 4%. Look on this slide, you can see 25, 30, 35-year retirement. Withdrawing at a rate of 4% has a very low probability that you're going to outlive your money. So, whether you're just taking your RMD amount each year or you're planning your decumulation strategy so that you don't run out of money, 4%, even if you go to 5%, pretty low probability. But when you get up into those withdrawal rates of 6, 7%, and you're living 25 years or longer in retirement, even if you have a pretty high exposure to the stock market, you'll see, it might be in and around that 50% chance that you're going to outlive your money. So that's why you want to stay in those lower withdrawal rates, still have a diversified portfolio, but those factors are going to determine how long your money lasts in retirement. So decumulation, 4 or 5% are going to be your safe rates. How you do that is, you can just stick with your RMD amount, take that out each year, diversify that money so that you make sure you're making at least the 4, 5, 6% each year. Then if you're returning that much, you're taking that much out of your account, you're not going to have to worry about running out of money. And that's important also with inflation. Inflation's been in the headlines a lot. And retirement is a long period of time, as we just saw. Average retiree is going to live 20 plus years in retirement. If you're planning for 25, 30 years, well, inflation can still impact your nest egg even into retirement. So there's that risk of safe investments that I have on this slide. You know, if you reach retirement and you have zero money exposed to equities in the stock market and just go into a very safe retirement, well then, yeah, the market risk isn't going to affect your portfolio. You know, the up and down movement in the stock market isn't going to affect you, but inflation can still eat away at your nest egg. And we're still talking about 20, 25, 30 years in retirement. So that's still a long period of time where inflation can have a serious impact on your nest egg and how long it lasts in retirement. So you see, you know, if inflation's going up by 2% and you're making 2% in a very safe investment, you're really just running in place. You're not growing your money any longer. With a mix of investments, you know, mixing in things like stocks and bonds, you know, you can still outpace inflation. You can make 4, 5, 6% a year pretty safely. If inflation's 2%, well, then you're still outpacing inflation, growing your money even into retirement. That's going to help your money last throughout your lifetime. So there is still risk of safe investments. You know, it's just a risk that we don't think about all the time. We think about the market risk with the up and down movements in the stock market, but there's still risk associated with that, and that's why you saw in that previous slide, all those different portfolios will mix in, you know, a blend of stocks and bonds. Another way you can see how much you can safely take out and making sure your money will last throughout your retirement is just a really easy measuring stick. I'll use this website all the time, immediateannuities.com. Plug in your nest egg amount. An annuity is a lifetime stream of payments that you're buying. And that's from an insurance company. You turn over your money, whether it's your entire nest egg or just part of it, for a guaranteed stream of income for as long as you're going to be alive. So that's an easy way. There's no obligation. You just plug in your number, how old you are, when you're going to start receiving those payments, and see what would an annuity pay me? What would an insurance company pay me if I turned this amount over to them and gave up all the responsibility, you know, all the risk, and they're just promising me a monthly payment. And that's also a way to see, okay, based on your nest, how much can you take out so that you have a pretty low probability of outliving that money. And then using your tools that are available to you in your retirement plan. So we saw one of those options is just to leave money in your retirement plan at work. So if you leave it in your plan at work, you're going to have like a target date fund or a risk-based retirement portfolio available to you for investing. And those target date funds, when they reach your retirement age or a retirement risk-based portfolio, they are going to have that blend of lower risk and higher risk investments like stocks. So they're going to have a diversified portfolio, and you'll see their long-term returns are going to be in that 4 to 6% range. So if you have something like a target date fund, or if you have a risk-based portfolio that's you're in the retirement portfolio or pre-retirement portfolio, you know that you're going to have a blend of investments that's going to return over the long term in that 4 to 6% range. So if you're drawing down on your savings at 4 to 6%, there's zero chance that you're going to run out of money. So that's an easy way to make sure that you have a diversified portfolio. That's why those options are available in your employer-sponsored plans. Now, when you go outside of your employer-sponsored plan, you go outside of the 401k, 403b into your own IRA. Well, then hopefully, you're savvy enough to do that diversification on your own. You're working with an advisor, something like that. But if you're sticking within the 401k, 403b, these options are really easy to make sure that you're still diversified, still earning enough so that your money's not going to run out too soon in your retirement. Our next segment is taxes, and we'll look at how taxes impact your decision making. We talked about the ages where taxes come into play: 55 for employer-sponsored plans. If you separate in the year you turn 55 or later, 59.5 across the board if you want to be safe, where you're paying less taxes or possibly no taxes at that point. Don't misconstrue any of this information, please, as tax advice. I am not a CPA, so I'm not licensed to give tax advice. It's just general information, stuff to consider, important knowledge for you. We do operate in a marginal tax system. So, as you pay your taxes, the more money you make, the higher rate you pay. It can be a little bit complicated for people to understand, but it's important to to be familiar with when you're looking at your withdrawal options from your retirement plan. This just shows an example. Let's say you have a high income earner, so it shows this person moving way up in the tax brackets. They're filing jointly, so it's a married couple, so these are joint tax brackets. But you can see on their first roughly $20,000 they earn, it's taxed at a 10% rate. Then it steps up to 12% for that next roughly $60,000. Then they move up into the 22 and on into the 24% tax bracket. So not every dollar is taxed the same. There are these steps that we take up as we earn income, both before and after retirement, that will impact our decisions. So just a quick refresher on the fact that we operate in a marginal tax system. These considerations will have influence on how we save our money while we're working, if we're putting into either traditional or pre-tax type of savings or the after-tax savings. There's a little bit of guessing that's involved with this too. Nobody knows for sure what future tax brackets will be. Might be hard to say for certain what your tax situation is going to be decades in the future, but general rule of thumb, you'll see go traditional or go pre-tax if your tax rate's going to be lower in retirement. If your tax rate, your tax bracket's going to be roughly the same, that's kind of a push, not a big difference, though we will see having Roth savings provides you additional flexibility and independence, so there is an advantage there. But if you think your taxes are going to be higher or tax rates are going to go up in the future, then you might want to look at the Roth savings, assuming that's an option through your retirement plan at work, or you could go into a Roth IRA on your own. Other things that factor into that decision while you're still saving, Roth versus pre-tax. I always talk about the two T's, taxes and time. It basically boils down to that. As we saw just on that previous slide with the teeter-totter, if taxes are going to be higher for you in the future, then look at Roth. If they're going to be lower, look at pre-tax. If you have a lot of time until you retire, then Roth can be more advantageous because you build more earnings and interest that you're going to be able to pull tax-free in the future. If you're within 5 years, time is short before you begin your withdrawals, you probably want to avoid Roth and just look to pre-tax, because Roth does have that 5-year requirement where they want your money to have, or they want 5 years to have gone by since the first Roth contribution that you made. The taxes and time factor into that decision between pre-tax and Roth, but there are definite advantages to having that flexibility of having multiple sources of income, pre-tax and Roth. Another hypothetical example for you on the top, you say this person, they both have $500,000 in savings, but the person on top has $500,000 all pre-tax. They're going to take out $50,000 a year. That's what they need to get by in retirement. As an individual, that's going to move them past the 10 and 12% tax brackets and on up into the 22% tax bracket. So if we look at all the taxes they pay across those different brackets, we talk about their effective tax rate is going to be around 13.5%. They don't have a choice. Everything they have is pre-tax, so everything they take out is going to be taxed, and would see them going into a 22% tax bracket. Now on the bottom, if the person's got half Roth, half pre-tax, they have more flexibility. They can fill the tax brackets, as I say on this slide. So they could say, first, I'm going to pull from my pre-tax savings, but I'm not going to go up into that 22% tax bracket. I'm going to pull roughly $40,000 out of my pre-tax savings. That's going to keep me in that 10 and 12% tax bracket. Then anything I need beyond that, I'll pull from my Roth, so it doesn't move me into the 22% tax bracket. So they can fill those bottom two tax brackets without going into the third, and that's going to be a benefit to them. Their effective tax rate is going to be quite a bit lower, like 9.3%. So if you have those Roth savings, it gives you that flexibility, that advantage at retirement, where you can work on filling those brackets and not going into the higher tax brackets. Traditional thinking is that when you pull money out of accounts, you pull first out of taxable accounts, so just taxable investment accounts. Then you look at the pre-tax savings. Then you look at Roth. And that is the idea behind that is you always want to keep the Roth invested as long as you can, earning those tax-free earnings, letting those build as much as you can, and also legacy factors into that. Roth dollars you can pass on tax-free to your beneficiary. But I like this idea of filling the brackets. If you have those Roth dollars, you can be more efficient with your taxes that you pay in retirement, and just work on filling the bottom brackets without going into the higher brackets, and just slowly pull from your Roth savings to more efficiently withdraw your retirement savings in the future. If you don't have Roth, then you don't have that advantage. So there's definite benefits to including Roth in your retirement savings if you have that option available to you. The last segment is looking at some important documents. Again, I'm not an attorney, so no legal advice, but just food for thought. Important stuff that you should really have in place at any time, but we really start to think about this as we approach retirement and think about our retirement preparedness. So we'll look at some of these important documents as you enter that final quarter of your life. Make sure you have your will in place. A will is where your assets go upon death. So what I'll point out to begin with is accounts that have beneficiaries, like your retirement accounts, like your 401k, your 403b, like life insurance. Those go directly to your named beneficiary. But a will is going to go through a probate process and then determine where your other assets are to be directed. So the things, cash, car, maybe your home. There's no cost for naming beneficiaries. So make sure your beneficiary is up to date on your 401k, 403b. That's the easiest, best way. Have those monies passed on to your loved ones when you pass. The will is really in place for everything else, but there's a costly, timely process involved with that probate process for determining where those assets go in your will. So you don't want, if you don't have to have things go through the probate process, avoid that with your direct beneficiaries. Make sure your beneficiary is up to date on your retirement accounts. Or you can look at something like a revocable living trust. So a trust is another means of passing assets on to beneficiaries. So unlike a will, a living trust isn't necessarily at time of death. You can set up a trust while you're alive, and it can take effect, while you're still living. You can retitle those assets to go into the trust. You would be the trustor. And if it's a living trust, it's revocable. That means you can change it. It's, while you're still alive, you can still change it. But then in your passing, there's a trustee or the designated, and those assets would be distributed to the beneficiary, so it doesn't have to go through that probate process like the will. It can be a little bit easier, something to consider. A will versus a trust. Again, will is upon your death. Living trust, is before or after death. It's set up before death, and then it's got a process in place for after death. With the will, it goes through probate, so timely, can be costly, thousands of dollars. That probate process. A living trust, remains private and can eliminate some estate taxes in certain circumstances. So a trust setup. Important things to consider as, again, you approach your retirement years. Having your will, having a trust, if that's something that you want to look at for those advantages. Having the healthcare directive, so if you're incapacitated, someone can make medical decisions for you, power of attorney. So again, if you're incapacitated, someone can make those. So if you don't have those documents in place, think about that. Those are other steps that you can take to have yourself in a good position, you know, in your passing. Things are, with 401k, 403bs, with those direct beneficiaries, it's super easy. You know, some of these other things, or if you're not able to make decisions for yourself, make sure you have these documents in place. Some takeaways from our material that we presented to you today. You know your options for age at which you can retire. So those important ages, how those affect things like taxes. You know, as they say, the only two things that are certain are death and taxes. So understand the taxes that you'll pay as you begin withdrawals, our marginal tax system, so you understand tax efficiency and how you might be able to better approach taxes in retirement. Get those important documents in order. Reach out to us for help. We're always here for you at Hayes Financial Group, so if you have questions, don't hesitate to reach out. You can set up time on our calendars, scanning this code that you see right there on this slide, visiting our website. You know, I didn't talk about budgeting. I mean, there's a lot that you can talk about as you approach retirement. We have a budgeting presentation that's recorded on our website there at Hayes Financial Group in our resources section. You can call, but the easiest way is to scan that code. You can do it at our website too. You can go to our resources section, and right at the top, you'll have a schedule a consult link, so you can schedule time with us or scan that QR code. That'll take you to our calendar, and you can put time on our calendar to discuss anything that we've mentioned today or anything that we didn't talk about. I know it's easier a lot of times one-on-one, so that's why we'll bring you these webinars, but we know that we hope to speak to a lot of you on an individual basis as you set up those appointments, and we're always here for you.